Fed speak. Loretta Mester of the Cleveland Fed. Loretta Mester saw compelling reasons to go 50 basis points at the last meeting. Equities down and down hard. As your opening bell, switch on the board and get to the bond market. Yields look a little something like this on a 10-year higher by 4 basis points to 384. We are near the highs of the year across the curve on a 10-year at 384. On a 2-year at the moment, just short of them at 2 basis points, close to 465 after coming close to 470 at 469 intraday in yesterday's session. Dollar showing a bit of strength, euro some weakness, back below 107 at 106.71 with negative 0.2% there, and crude just about holding on, $78.60. We're unchanged on the session. About 30 seconds into this, equities down 1.1%. We'll see if that sticks on the S&P. On the Nasdaq, we're down 1.4%. Bear in mind, we've had tons of outperformance on the Nasdaq so far year to date. Let's get you one name, Cisco, moving higher after delivering an upbeat forecast. The CEO, Chuck Robbins, expecting demand to continue, saying this: I don't want to paint a picture that we're immune, but we've been able to see our customers moving forward with their projects. Ed Ludlow has more. Hey, Ed.
Yeah, good morning, Jonathan. Shares up around 3%. Anything above 3.5% would be the biggest jump since November. The stock trading at its highest level since around May of 2022. A lot to jump on here. They're bucking the trend of what we're seeing in corporate America. Initially, for the coming quarter, the period ending in April, they see sales rising 11 to 13%, almost double what the street was anticipating they'd say, thinking that they would say sales would grow 6%. Those are the numbers that they just printed. Additionally, for the full year, the guidance was strong as well. We're going to see top line growth of 9 to 10.5% in fiscal 23, and profit will be around $3.73 to $3.78 a share. Around a dozen analysts, John, have raised price targets on Cisco or upgraded their call on the stock. One reason being that basically during the pandemic period, Cisco had a backlog of orders. They kept the new business coming in, and now they're managing that process very well. There's still a pipeline there. The kind of harder story to quantify is actually Cisco's finding relevance right now. Yes, we know about layoffs. Yes, we know about companies pulling back, but they're handling a lot more data, which makes Cisco's offerings all the more attractive at this time. But really, it's that handling of the order backlog, the bullish outlook going forward. And as I said, that stock pushing higher, bucking the trend of the market this Thursday.
That stock's up right now by 3.8%. Ed, thank you. Different story for Paramount. Weaker advertising revenue, offsetting gains from its streaming service. For more, here's Katie Greifeld. Hey, Katie.
Hey, John. Of course, we're talking about Paramount. Media giant owns CBS and other networks as well. Taking a dive this morning after, like you said, it reported fourth quarter numbers that miss on both sales and profit, which ties back to that very familiar story, advertising. Of course, ad sales for the legacy TV business dragged down results, even though the streaming side continued to grow. So you add that together, shares are down about 6% or so this morning, even though media overall has been a bright spot in 2023. Warner Brothers Discovery leading the way there. It's up over 60% or so year to date. And even with today's dive, Paramount is still looking at year-to-date gains of almost 40% or so. And a lot of those gains, of course, are coming from optimism over the streaming business. So let's take a look at the subscribers, what we're actually talking about here. Paramount, it added almost 10 million new subscribers in the fourth quarter alone. That brings its total to 56 million. As you can see, that's still dwarfed by the likes of Amazon and Netflix and even Disney Plus, but the trajectory seems to be higher, John.
Katie, thank you. That year-to-date board is absolutely amazing. Katie, thank you. Let's bring that up again if we can. Paramount year-to-date up 36%. Warner up like 57%. Walt Disney up something like 23%, 24% higher. It's just phenomenal year-to-date gains on some of those names. Not just those names, but the travel names as well. Hyatt posting per room revenue forecast well below its competitor Marriott. Those numbers came this morning. Here's Abby with more. Hey, Abby.
Hey, John. Yeah, it's a similar story. We have the travel stocks absolutely on fire this year, of course, because we've had this continued demand, a surprise to many people. A year ago, it was revenge spending, revenge travel after the pandemic. But here we are a year later, and we're still seeing it. So in the case of Marriott, it's so amazing, or excuse me, Hyatt, it was actually at a record high yesterday. Today, as we were just showing, not so much, down about 4% or more, but a very strong quarter. They beat adjusted earnings. They put up $2.50. That's a beat by 622%. Revenue's better, net income better by almost 700%. So again, this is the kind of strength that these companies companies are seeing. On the other hand, a flip side of it, RevPAR, a measure of revenue per room, because during the pandemic there were fewer travelers, we're looking at uneven comps. So they're looking at 10 to 15% RevPAR growth this coming year. However, this coming quarter. But when you compare it to a year ago, well, it's going to be a tough comp. So that could be weighing on shares. But let's take a look at another year-to-date board. Not quite as dazzling as the media board, but here are the gains in the travel sector. The key takeaway is this massive rally. Some of it could have to do with the savings rate dropping, John. Right now, the personal savings rate here in the U.S. around 3.4%, off of that pandemic peak of 34%. Maybe a lot of that money coming out of bank accounts as folks want to get out there and live, going into these hotels, airlines, gambling, all of it.
So impressive, these year-to-date gains again. Abby, thanks for that. Just the broader market at the moment, this morning and 5 minutes into the session, we're down a little more than 1% on the S&P. On the Nasdaq, we're down by 1.4%. Wall Street really struggling to figure out this market. We've had calls for a more aggressive Fed, getting some validation, that's for sure. This year's rally, though, suggesting otherwise. JP Morgan's Marko Kolanovic saying this behavior isn't just fighting the Fed, it's taunting it. RBC's Richard Bernstein telling investors to fade the move higher. He says this, it's based on the hope the Fed will soon return cheap and abundant liquidity. It's highly unlikely. The Fed has no intention of being the hero of speculative investments. Richard, I'm pleased to say, joins us right now. Richard, great to have you with us on the program. Let's start here with this regime. You said rates high for longer. You said sticky inflation. You've nailed those calls. What you struggled with is the equity leadership, tech. Why is tech outperforming year to date against that?
So, John, good morning. I think tech is the epitome of that speculative fervor that's still in the market. You know, as you pointed out, somebody had said that the ultimate fighting of the Fed. Speculation requires huge amounts of liquidity, cheap and abundant liquidity. And if you think about, 2020 to 2021, we certainly had cheap and abundant liquidity, record amounts of cheap and abundant liquidity. The Fed is now trying to sop that up. But you have this hope among speculative investors that we're going back to that previous regime and that inflation will suddenly subside, the Fed can ease, we'll have sub 2% inflation, and we go right back to that speculative environment. We just think that's very unrealistic given the economic data, given the Fed. We think the whole regime is changing, but yet investors haven't caught on to that yet.
So, Richard, I struggle with this. I've always struggled with the idea that there's a room somewhere that exists on trading floors where the bond guys sit, and they sit and trade bonds, and they know something the equity traders don't know because they sit somewhere else and no one talks to each other. Are we saying the bond market's right and the equity market's wrong?
I'm not so sure about that, Jonathan, because if you look, if we take away treasuries for a second and we look at credit spreads are very narrow. Given that we're sliding into a profits recession, one would expect that credit spreads would be wider. But credit investors right now are similar to the speculative investors, somehow saying this time is different, that, we're going to have a profit recession, but credit will be fine. That's a little bit hard to figure out. So I'm not sure that bond investors are looking at anything differently than speculative equity investors are.
How do you think this reconciles? What do you think will resolve this issue?
I think, unfortunately, for a lot of people, it's going to be disappointment yet again. I don't understand why people still are momentum investors. I think you would have thought that 2021 into 2022 would have washed out the momentum attitude and people would have become more fundamentally based. But clearly, that has not happened. And so that sets up what's the downfall for momentum investing is always hanging on too long. That's where you underperform as a momentum investor, and I think we're going to see that again.
So a part of the equity market you have liked, and let's be clear about this, you haven't just hated equities, you just didn't like tech and didn't expect
Correct.
The leadership to come from the US or from tech, and that's where the outperformance has been. You have liked Europe, and you have liked the rest of the world. So let's go there. Richard, the year-to-date gains of some of these European names is really impressive. I talked about Hermes, the luxury goods maker, Air France, KLM, one of the biggest carriers in Europe. Those year-to-date gains were up like 20, 35%. Got record highs in France, record highs in the UK. Do you see reason for that to continue, even against the backdrop where you think tech and US equities could run into trouble?
Yeah, so I think, let's look at this from a purely investment point of view for a second, just kind of get down in the weeds. I hate to do that, but let's do that for a second. The U.S. market is dominated by three sectors. It's dominated by tech, it's dominated by consumer discretionary, and dominated by communications. Those three sectors still make up about 45% of the U.S. market. That is not true in the rest of the world. And what we found in 2022 was that country performance was directly related to how little exposure the country had to those three sectors. So our attitude is that we just don't like those three sectors. Everything else is fair game. Our attitude is that the menu of investment opportunities, whether it's not in those sectors in the United States, whether it's in other countries, whether it's in other industries, the menu of opportunities is extraordinarily broad. It's just that nobody wants to look outside of those three sectors in the United States. So John, yes, I think there's plenty of opportunities, whether it's in Europe, whether it's in Japan, whether it's in China, whether it's in energy, whether it's in consumer staples. I think the menu of opportunities is very, very broad right now.
What's clear to me, though, Richard, is you're looking for some of the outperformance so far this year, to run into some trouble. And I'm trying to work out when it indeed does run into trouble, if you are right. How does Europe look in that kind of market? Are we looking for relative outperformance, or do you still expect absolute performance, positive returns against the backdrop where you think the US equity market's going to run into trouble?
Yeah, that's a very fair question. I'm really talking about relative performance. Look, we're in an environment globally, with the exception of China for a second, where central banks are tightening and profits are decelerating. Right? In China, you have the opposite. Profits are accelerating and the central bank is easing. But outside of China, that's generally the way to think about it. In fact, I think it's about 45 or 50% of the world's yield curves are now inverted. So we're not looking at what would normally be a great environment for equities overall, right? You'd like to see central banks easing and profits accelerating, not the opposite. So I think we are talking a little bit about relative performance. However, one has to remember that volatility always signals a change in leadership. So if that happens, and if the global economy is changing, we're starting to see that change of leadership in a bearish environment, that signals that the new bull environment will have very different leadership than this tech consumer communications type leadership that everybody wants to have be the leadership.
Just thinking about risk reward at the moment, though, Richard, here's the challenge for a lot of people. Do I want to play that complicated game of relative outperformance in equities when it's really tricky right now and the incoming information is telling me that a lot of people, their consensus view on this economy in the US may well be wrong, when I can just take a 6-month T-bill, sit on 5% and sit this whole thing out for the rest of this year?
Right. Well, John, I realize everybody is a perfect market timer, and we all get back in at the perfect moment. I get that one, but let's assume for a second, for those of us who are maybe not that perfect, I think the relative performance game is important because you want to keep a certain equity exposure within your portfolio, right? Assuming that one's trading for quarters and years and not for days and minutes, that basic equity exposure remains very important. So I think, look, I think, we all kind of poo-poo relative performance, but I think it's very important in terms of longer-term performance to keep some kind of a reasonable equity exposure.
I'm not looking for perfection. You know that, Richard. Never. Richard, thank you, buddy. As always, it's good to catch up. Richard Bernstein there on this market. Equities right now down 1.2% on the S&P. 13 minutes in on the Nasdaq, we're down 1.4%. Coming up, here's a headline for you. President Biden and Elon Musk kind of reconciling.
Tesla has dominated the EV market. It still does. It still will.
That conversation up next.
The price of electric vehicles, at one point it was, the average price in our calculations was about $66,000. That's more than the household income for most Americans. So we are seeing that come down a bit, some of that because of Tesla's moves, but also because we are seeing automakers start to introduce less expensive ones. Tesla has dominated the EV market. It still does. It still will.
President Biden offering rare praise for Tesla's CEO, writing in a tweet the following: Elon Musk will open a big part of Tesla's charging network up to all drivers. That's a big deal. It'll make a big difference. The move making Tesla eligible for funding as part of the bipartisan infrastructure law. Team coverage starts right now with Bloomberg's government's Jack Fitzpatrick in DC, Ed Ludlow on the West Coast again. Jack, first to you. Are we making friends here?
It hasn't exactly been a romance between Biden and Musk. This is an interesting little détente because there had been times when Biden wanted to talk about electric vehicles and had kind of made a point of excluding Tesla. There was an event with Ford and GM that they weren't invited to. I don't know that it's going to be an absolute thawing of that relationship. Some of the Twitter politics has gotten between them. So I don't know if it has become, I guess, brotherly love between these two. But it is a notable thing that has connected Musk and Tesla to some of the money available under the infrastructure bill that was enacted last year.
Ed, what do you make of this?
Yeah, look, it's important for the broader push to electrify. The pledge from Tesla is 7,500 chargers split across 3,500 super fast chargers and around 4,000 more sort of standard installations. You know, I think back to July of 2021, John, and I think about the stock. I think about Tesla. Goldman Sachs in July of 2021 published research that said if Tesla ever did this, they could realize annual revenues, additional annual revenues of $25 billion. And that's been the frustration with Tesla, that actually if they opened it up, their brand and their kind of incumbency in this market, that would give them another lever, right? Even if people aren't buying their vehicles, it's another service that they can offer. But just like Jack, I don't necessarily think this is a full-on détente. You know, Musk has felt pretty aggrieved in the past, but for the broader initiative to expand charging infrastructure, it's important. But Tesla's still a number 2 player in this country. Don't forget ChargePoint, which we talk about less, has many more chargers across North America.
And I've always thought it was bizarre that this administration didn't include Tesla in more conversations, including Elon Musk. Elon Musk has talked about it. We've all said the same thing. It doesn't look right. But Ed, what it seemed to come down to was union workers, which this president just keeps going on and on and on about.
Yes.
And can you tell me what's the latest on that front with Tesla?
Yeah, so overnight, according to a complaint filed by the workers at a Buffalo, New York plant, some individuals have been terminated in the last 24 hours or so, having initiated an effort to organize a union effort on Tuesday in the same plant. This effort relates to a small group of employees who are autopilot data labelers at the Buffalo facility. In total, there's 800 people on that team. And, you know, they were basically pushing through an affiliate of the Services Employees Union to do this. There's been no response from Tesla, but, you know, all we have to go on is this complaint that's been filed that says, following that effort to organize, following actions that they took on Tuesday, February 14th, handing out leaflets to their colleagues in that plant, some of them have been dismissed.
Jack, is that where there's daylight between the president and Elon Musk over this issue?
That's where there's a big portion of the daylight. There are some other areas. Again, the interest in social media and Twitter, I think, has gotten between them. There was an instance in which the president said it might be worth looking at his connection to foreign investors. They have political differences. You know, you even look at recently the decision by Musk to go visit Kevin McCarthy. He also happened to essentially bump into Hakeem Jeffries. Really, they have political differences, and it gets into the union stuff, some of the foreign investment, and even social media. I think there are a few issues like that that get between those two personalities, but there is a clear bridge between them in the president's interest in investing in electric vehicles and the related infrastructure.
And I want to give you the final word. It doesn't seem to make the slightest bit of difference for the stock this year, at least, year to date of 73%.
Yeah, I think we're under a little bit of pressure in this session. I think that has a lot to do with the broader market and Fed comments. But, Tesla has revived its fortunes. It's shown that it can use price cuts as a lever to initiate demand. And I think that actually the street was relatively bullish on its last earnings print for this year. All eyes on March 1 Investor Day, where we get the kind of next 10 years worth of planning. But, Tesla has momentum, still trades at a pretty high multiple though, John.
What a year-to-date rally. Ed, thank you. Ed Ludlow on the West Coast, Jack Fitzpatrick down in DC. Your equity market more broadly, 22 minutes in, we're down 1% on the S&P, on the Nasdaq, down 1.2%. Let's lift the lid on some of these indexes and get you some sector price action. Here's Abby.
Hey, John. Well, not surprisingly, with that decline for the S&P 500, the worst day of the month, we are looking at 8 of the 11 S&P 500 sectors trading to the downside. What's so interesting is this expectation that the Fed is going to continue have to lift more than what had been thought just a couple of weeks ago. That is shaping the sector positioning because we have real estate and utilities. Those are the worst two sectors, both down 1.6% or more. That has to do with the fact that their dividends look less attractive when yields go higher and the expectation that they may go higher yet. On the year, if you want a year-to-date board, John, let's check this out because the crypto space, it really even puts media and travel to shame. Take a look at the Bloomberg Galaxy Crypto Index, up 49%. Coinbase up 85%. Marathon Digital, Riot platforms also up in a big way, a double, having to do really with this risk-on mood and folks really moving to momentum.
Abby, thank you. It's truly impressive. Richard Bernstein was talking about it 20 minutes ago. Can this continue against the backdrop of higher interest rates and higher yields? 367, 467 almost right now on a 2-year. Coming up, your trading diary. Twenty-six minutes in, almost. Yields up, stocks down by 1% on the S&P, down by 1.2% to be precise on the Nasdaq, down by 1.25%. How much of this will get bought through the rest of the session? Look out for that. That's the price action. Here's the trading diary. Coming up, DoorDash, DraftKings reporting results after the closing bell. Fed speed continues. Bullard, Cook, Mester, all on deck this afternoon. Richmond Fed President Tom Barkin, Fed Governor Bowman speaking on Friday, and finally, the Munich Security Conference kicking off tomorrow in Germany. We'll catch up with Maria Tadeo going into the weekend. From New York City, that does it for me. Thank you for choosing Bloomberg TV, and as always, good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg TV.
great questions. From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Thursday, February 16th. Here are the top market stories that we're following for you at this hour. Mester crushes equities. Cleveland Fed President Loretta Mester puts 50 basis points back on the table, dragging down markets, and producer prices come in hot. And setting records in France. The CAC 40 barrels to a record close. The FTSE 100 at one point topped 8,000 before the U.S. markets weigh it down. We're going to see how much juice there is left in Europe. And housing, hotels, and engineering. We're going to talk to executives from Taylor Morrison, Hyatt, and Arcadis for the view from the C-suite. From New York, I'm Alex Steele with my co-host in London, Danny Berger. Guy Johnson is off today. Welcome to Bloomberg Markets. This is my favorite quote of the day. Trading U.S. equities is an untradeable mess. U.S. equities are an untradeable mess. That comes from Nomura, and I think that speaks really well to positioning and then options and then how we respond to news right now in the equity market.
At least, Alex, at least we are finally selling off today. At least it makes some sort of sense with yields at their highest for the year. And I mean, look, right when this market thinks it has the Fed figured out, it gets another hot piece of data to come slap it in the face.
Yeah, exactly. And also initial jobless claims rolling over as well. Continuing claims, though, may be showing it's harder to get a new job if you've lost your old one. But the overall weekly claims number continuing to come in lower. So this is what we're talking about. This is what Mester said earlier at a conference. At our meeting 2 weeks ago, I saw a compelling economic case for a 50 basis point increase, which would have brought the top of the target range to 5%. Danny, I really thought that 50 was done for now.
I know. Well, Alex, I really miss being able to say jumbo rate hike. So I, for one, am happy that it's probably back on the table. It's good. It's important, though, to note that Mester isn't a voting member, but the market doesn't care, Alex. Yields are moving higher. It's pricing in a higher terminal rate, which gets us to our question of the day. Is a 50 basis point hike back on the table? Here to help us try to answer this is Bloomberg's Katie Greifeld and Michael McKee. Mike, let me start with you. Given that we got another hot data print, PPI this time, is 50 back on the table?
I think 50 is back on the table. It's important to note that Loretta did not say she wants 50 at the next meeting on March 22nd. She said she could see a compelling case for it at the February 1st meeting. Now, one would assume that the case only gets more compelling given the inflation numbers that we have seen. I think what we really need to do is take a step back and look at what the Fed was suggesting in their SEP, their views of what's going to happen on December 14th. And you can see there the 2023 dots. The consensus was for 5.1%. But look, there are 7 dots above that, including 2 at about 5.5%, a little over 5.5%. And so they were thinking, an awful lot of them were thinking at the time that they needed to go higher than the market anticipated. And so now it becomes a reality. If you're at 4.75 and inflation is hot and you want to send a signal, then 50 basis points becomes a real possibility. The only caveat I throw in there is another CPI, PPI, retail sales, jobs report before the next Fed meeting, so we could all be coming back to this show. And the question of the day would be, is the Fed going to cut rates?
Oh my gosh, I feel like
I don't think we'll go that far, but we could change our minds.
We'd have to see a really bad jobs print. Hey, Katie, are we looking at the market? Are we even recalibrate here for 50?
It seems like that's the case in the stock market. I agree with Danny. It kind of is a relief to see stock markets finally make sense, down 1.3%.
And we're saying make sense because the options have really messed it up for a day-to-day action read.
Right, for sure. And I mean, if you think about this disconnect that we've seen in the stock of the bond market, I know we were talking about this 2 days ago, where it feels like the bond market is on board with what we've been hearing from the Fed, that the stock market hadn't really been taking those cues. Today they are. I mean, the S&P 500, we're only half an hour into trading. It's already off by 1.3%. Then you look at what's happening in the bond market. The 2-year Treasury yield, which is really where these expectations get priced, only up about 3 basis points. And when you think about, this tenor moving 20 basis points or more in a single week, this is pretty muted. So maybe a recalibration in the stock market, but the bond market already saw this.
Well, Katie, can I just make the argument that maybe the bond market is dumb too? I know you flagged this. Only just now are we seeing 1-year break-evens rise to 3%. been pretty well anchored until very recently.
I think that's such an important point, because when you break apart the rise that we've seen in nominal Treasury yields, break-evens, and real rates, it's been break-evens that have been driving it, those inflation expectations. So to that point, the one-year break-even is about 3% right now. You look further out, 10-year at about 3.85%. Inflation expectations have been rising, and it makes sense when you pair that up with what we're hearing from Mester and other Fed members. We know they care about inflation expectations, and they've definitely been on the rise here, above that Fed 2% target. I know that 3% is higher than 2%.
Mike, if we don't see more conversation about 50, or the minutes, for example, next week not really talking about 50, from the data that we keep seeing and from this kind of rhetoric, can we assume that maybe longer rate hikes?
Well,
like 25 in June, then do we get 25 later in the summer?
Yeah, we could certainly see that, because they are being cautious now that they've gotten close to what their target is, their terminal rate is. They want to make sure they don't push us into recession. At this point, the economy data is very strong, the growth data, and the inflation data are sticky. So it would argue for being able to go faster, but they are going to want to be cautious, maybe see what happens, particularly with the jobs report for February at the beginning of March, and then they can decide whether they want to do something fast or slow. Minutes next week will be interesting to see if anybody else was also looking at 50. And we have a number of Fed speakers today, and we'll have more next week. We'll see if anybody else joins that parade. But I can tell you, Loretta's now taken the fun out of the minutes next week. We already know what the big headline is going to be.
No fun. Why pay any attention at all? No, Mike, in all seriousness, it is important. I do wonder how much credence you give to the no landing argument. It just seems to continue to gain steam in the past few days, Mike, given all this data we've got.
Well, no landing basically suggests that the economy doesn't slow down, but inflation falls away. The inflation numbers have come down. It's important to remember that. They're not coming down as fast as maybe the markets thought, but they have come down. So there's a possibility they get to that range that the Fed's talking about, around 3 to 3.25% by the end of the year. And if we don't see unemployment rise significantly, if we see growth stay strong, Atlanta Fed GDP for the first quarter is currently running 2.4%, then you've got what they're calling a no landing scenario. The only problem we have is that all this data changes on a month-to-month basis. So we can call it what it might be now, but again, as I said earlier, by the time we get close to March 22nd, we may be talking about a different outlook.
Katie, I'm also wondering, we talked about the market distortions. Like, I get that today makes sense. Equity's down 1%, but I also am a little skeptical that they're going to stay making sense. The options market has been really distorted. The positioning has been really distorted. What are you hearing on that?
Well, I know that the rise of one-day options, it's been a conversation we've been having for a few years now, really since the pandemic, when we saw the rise of retail traders.
You're going to say gamma, aren't you?
I was gonna dance around it, but
bring in the Greeks.
But you think about what that means from a market structure standpoint, and you factor that into what we've been seeing with the VIX, the fact that the VIX has been feeling broken for a while now. It makes sense when you think about the VIX as a 30-day look ahead. People are increasingly trading single-day options, and that mystery, again, maybe seems to be solved a little bit. The fact that you've seen the VIX so out of step with what we've been seeing with the MOVE index measuring volatility in treasuries, that's the biggest takeaway for me. Again, what the longer term, what this means for the Greeks, for the gamma squeeze argument that was definitely playing out in like September 2020, maybe we could be heading there.
Yeah, that's what JP Morgan was saying too. The VIX now under 20 despite the sell-off we're seeing. All right, guys, thanks a lot. Good roundup to start the day. Katie and Mike, we appreciate your time. Coming up, more on the question of the day. Is 50 basis points back on the table? Patrick Palfrey, a Credit Suisse co-head of quant research, joins us next. This is Bloomberg.
easing season is here.
Big banks, that was the big story.
From the big banks to big tech.
Everybody is losing a lot of money.
It's a question of how high the bar is set.
Bloomberg breaks the numbers first.
A blockbuster number. Blowing through estimates.
These guys are minting money with exclusive expert analysis.
Does this approach make sense to you?
We're going to have to make an acquisition.
This quickly become just a really crappy business model.
I don't think their business is as broken as the world thinks.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
At this juncture, the incoming data have not changed my view that we will need to bring the Fed funds rate above 5% and hold it there for some time. Indeed, at our meeting 2 weeks ago, setting aside what financial market participants expected us to do, I saw a compelling economic case for a 50 basis point increase, which would have brought the top of the target range to 5%.
That was Cleveland Fed President Loretta Mester speaking earlier this morning, and that's before we got retail sales, CPI and PPI all coming in hot, which brings us to the question of the day. Is 50 basis points really back on the table? Patrick Palfrey, a Credit Suisse co-head of quant research and senior equity strategist, joins us now. Patrick, 50 bips on the table. What do you think?
Well, I think at the end of the day, 50 bips is probably going to be on the table in terms of subsequent meetings. I don't necessarily think it's going to happen at the next meeting specifically. I mean, we're talking about fine-tuning policy here, and there's a lot of moving pieces, a lot of incoming data that is giving different readings. The fact of the matter is inflation is coming down, but it's just not coming down quick enough. The labor market remains incredibly tight, and that is really a big source of that inflation. So the Fed is trying to manage that expectation, but a 50 basis point jump at the next meeting, I think is probably not necessarily prudent, and to take incremental steps forward here on the process.
Given all of that, Patrick, is the S&P 500 at 4,100? Is that reasonable?
Well, I think the question is, how did we get to 4,100? We started the end of last year. We've rallied almost 15% since October. The tone of the rally so far this year has taken on a more speculative nature. So when you look at, for example, companies that are the most beaten up, the most sold off, they've been the biggest winners in this rally. That type of response in terms of market leadership happens when you're coming out of a recession. So the market is really looking to pricing a softer or no landing scenario, as a lot of investors have looked for, because the economic data remains strong enough in the fact that we can continue to kind of thread that needle. Can we ultimately do it? I mean, the earnings pick drop remains very challenging. So we've had a big run. It's been led by stuff which is more speculative in nature. I think here we're going to move sideways for a little bit.
So what do you do with that then? I mean, would you have to chase that kind of rally? Because if you don't, then you're still going to sit on not a great quarter, especially if you're benchmarking, but you also don't want to kind of front run a thesis that's not playing out.
Yeah, I mean, we've seen a lot of investors chase that rally. When we look at how investors were positioned leaving the end of last year, they were underweight technology, particularly in the mutual fund community. And the VIX is still elevated at that time, so hedge funds didn't nearly have as much leverage employed. And what we're seeing is both groups, both mutual funds and hedge funds, begin to move into those positions. With the VIX falling, hedge funds are taking up leverage, and the long onlys are incrementally looking more into the technology area. So part of this is a bit of a chase and a catch-up. I guess the question is, are the fundamentals there for a lot of these names? And tech earnings still remain in a quite precarious situation. They are very at risk to some of the inflation dynamics that we're seeing. So it's going to need to play out on the earnings front, but we're seeing investors chase it and move into those areas.
And Alex and I were just discussing this a few hours ago, the distortion that's being credited to 0 days to expiry options. In other words, options that expire that day or the next day, just really short-dated options. Marko Klanovic at JP Morgan thinks it's going to cause another Volmageddon. Nomura is saying that on some days, 1 out of every 2 options traded are these short-dated options. Patrick, can you break down just how big of a driver these options are in terms of distorting any market moves?
Well, I think it's hard to know. I mean, what I can tell you is investors are really near-term focused. I mean, we're talking about things that have happened over the past month. As I mentioned earlier, the kind of speculative nature of the rally. Investors are moving in and focusing on momentum, and they're looking at other areas to try and kind of catch an upswing in the equity market. They don't necessarily want to own a lot of these areas. Investing in more speculative assets in an economic backdrop that remains questionable is not really a great recipe. So I think they're trying to use short-dated options and other instruments to ultimately get at a lot of the upside that we're seeing. But I think they're not necessarily looking to take ownership of a lot of these individual equities.
Interesting. So basically, you don't want to chase this is your way of chasing the rally, then, is through the options market. So, Patrick, what am I supposed to do if I'm not playing the options market? Am I selling rips then?
Well, I mean, I think if you're looking at sort of long-term equity ownership, which is what our focus is, I think you need to see what's going to do well over the next 6 to 12 months. I think tech is really not that area. The earnings remain impaired. We continue to like more cyclically oriented sectors, and maybe even some of the specific defensive areas here where the earnings are remaining intact. I mean, I think that's the key. Look for areas where you're seeing sales growth, because companies that are seeing strong sales growth aren't seeing the same kind of margin pressure. They're out there, and I would lean into those areas, but I would be wary of tech because they are exposed to the labor inflation in particular. We're seeing it in the current quarter. Margins are getting crushed during the fourth quarter here on a lot of the technology companies in terms of what they're reporting. That is not going to go away. So focus on where you're finding top line growth, because ultimately margins can hang in there.
But as a whole, margins are down in the fourth quarter. They're projected to be down again in the current quarter. Yes, there's some areas of brightness, but Patrick, I have to wonder, have we hit peak margin?
I think we've hit peak margin near term. I mean, typically margins peak when revenues begin to fail. And we are seeing that here, and that is only exacerbated by the labor issues that we're seeing. I think there's good inflation, there's bad inflation. Good inflation is things that take place in goods. These are things that the companies can pass on, and it drives higher revenues. The bad kind of inflation is labor inflation for many companies, because it's harder for them to pass on labor inflation. It tends to be quite sticky. And that's what we're seeing, is goods inflation is collapsing, and labor inflation is remaining really elevated. And that dynamic is uncomfortable for a lot of companies, and that's why we're seeing the margin pressure they're seeing in the current quarter. I mean, if we're looking at fourth quarter, revenues are growing 5%, EPS are down 2%. That's a big collapse in margins, and as you mentioned earlier, that is only going to persist for the next couple of quarters.
Right. Yeah, interesting stuff. Patrick, thank you so much. Patrick Palfrey there, Credit Suisse co-head of quantitative research and senior equity strategist. Still ahead on the program, Tesla fires dozens of workers at its plant in Buffalo, New York. A complaint says the termination happened just one day after workers announced plans to form a union. We'll have the details for you in the startup next. This is Bloomberg.
It's time for the Bloomberg Business Flash and look at some of the biggest business stories in the news right now. I'm Ritika Gupta. Air India could almost double what already stands to be the biggest aircraft order in commercial aviation history. The carrier has ordered a record 470 planes from Airbus and Boeing. Air India now says it has options to buy another 370 jets. A hedge fund star at BlackRock is raising $1 billion following his worst ever loss. Alistair Hibbert will reopen the BlackRock Strategic Equity Hedge Fund for more cash starting at the end of March. Hibbert's fund managed $7.6 billion at the end of last year. He lost 12% in 2022. And BP is adding to its network of U.S. gas stations. The British energy giant has agreed to buy Travel Centers of America for about $1.3 billion. Travel Centers has a network of 281 locations in 44 states that offer services including refueling, restaurants, and travel stores. And that is your latest Business Flash, Alex.
All right, thanks so much, Ritika. It is 22 minutes past 7 on the West Coast. Let's get right to the startup where we cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its morning. Joining us now, Bloomberg Technology co-anchor Ed Ludlow. That's a pretty nice sunrise, I gotta say. What you got today? What's on your mind?
Yeah, look, I think we're still tracking this story at Tesla, and it's actually happening out in New York State, right? What we're seeing with the unionization effort in Buffalo, the NRLB filed a complaint in the last 24 hours saying that those workers on the autopilot team that we discussed 24 hours ago who are making an effort to organize, making a union push, dozens of them were terminated following that push in very short order, according to the complaint. The difficulty here, as you guys know, Tesla does not have a press department, right? It doesn't have anyone we can go to and get a comment from. You know, as always, we'll email Elon Musk, we'll email anyone we have a line into, but there's no Tesla engagement on this story. But prima facie, it looks like a pretty rapid and quick response to stamp out that unionization effort over in New York.
What could be Musk and Tesla's defense in this case if one did happen in quick succession of the other? Is there a defense they could form?
You cannot fire people just because that they hand out leaflets, and you guys will remember that was what happened. So Tuesday, Valentine's Day, a very small group, around 25 workers who are working on data labeling of autopilot, right? These are not manufacturing or assembly line roles. They were handing out leaflets to their colleagues at the Buffalo facility. The poem on them was "Roses are red, violets are blue, the union effort starts with you." This retaliation, if it is retaliation, has happened quickly. What I would say is this is a really small group, right? There's like 2,000 people in that facility approximately, 128,000 globally. So it's really hard to know what's going on here. But as you guys know, the broader context, particularly in the technology sector, is that the unionization effort nationwide has had some success in the last year. That's why we're monitoring this so closely.
Yeah, I was asking our resident lawyer, David Weston, and apparently, yes, it is illegal to fire someone for forming a union, passing out leaflets, but you have to prove that that's why they got fired. Hence, we want to talk to their press department and see if there were other things that were going on. That's where, proven tension is quite difficult. Ed, stock going nowhere on it, which just leads me to believe that investors are just taking all this union stuff in stride. It really still feels to be about Twitter and Musk and then Tesla.
Yeah, I mean, on the unionization side of the story, this is not new, right? 2018 and 2017, there were big efforts to unionize Fremont just behind me over the water. Those were unsuccessful. As we talked about 24 hours ago, Musk has kind of, in the past, tried to call the union efforts bluff, saying, go for a vote, have a vote, and see what happens because of the confidence that they wouldn't do so. I look at the Tesla trading. We're softer in the session today, right? Those comments, sort of startling Fed comments earlier this morning. We were down ahead of the inflation print. You have to remember Tesla's still a stock with a high multiple that's trading based on how the market feels and also taking into effect macro factors. And year to date, it's really recovered because it's proved that it can use price cuts as a driver for demand. So I don't know how, to answer the question, I don't think investors have too much concern about this specific incident. But again, bigger picture, maybe down the road, it's a bigger problem for Tesla.
And Ed, less than a minute here, but I mean, this isn't the first time Elon Musk has bumped up against labor concerns. Wasn't there something with Twitter as well when he let go all of those folks?
Well, again, you know, when the mass layoffs at Twitter happened, there were a number of complaints filed against Elon Musk as the sort of owner and lead executive at the company, ranging from unfair dismissal right through to specific roles or teams that were cut in what they claimed were an unjustified way.
All right, Ed, thank you very much. Bloomberg Technology co-anchor Ed Ludlow. Now coming up, construction of new homes in the U.S. dropped for a 5th month. We're going to be speaking with home builder CEO Sheryl Palmer of Taylor Morrison next. This is Bloomberg.
We're about into the hour into the U.S. trading session. Hot PPI, initial jobless claims continuing to fall, and now it makes sense. Equities decline and yields are higher. Abby's tracking the moves for us. Abby?
Yeah, we are seeing that familiar relationship from last year. Right now, we do have stocks near the lows, but off the lows. So with this year's bullish attitude and positioning, you have to wonder whether or not we're actually going to see some sort of a bullish reversal on the day. We certainly are far from that right now, down about 0.9%. But again, we had been down closer to 1.2% earlier. Now hit the hardest, not surprisingly, because of that relationship between rising yields hitting tech stocks where valuation could be a little bit more of a concern. We have both Microsoft and Nvidia leading the way lower. The 2-year yield up almost 2 basis points, and then you of course have that 10-year yield up 3 basis points, 383 and 464. The idea with Loretta Mester today talking about 50 basis points, the possibility of that being appropriate, and most people now focusing on 25 in March and 25 in May, the idea that the Fed is going to do what they say that they're going to do, which is raise. Now, this, of course, has some positioning relative to options. Here we have technology options, QQQ puts at the highest level since 2008, a little bit of a spike. You can see trending higher overall during the last couple of years where we've just had this huge rally for tech, but again, over the 2008 level, so something to keep in mind. Some folks are a little bit nervous. And then finally, speaking of nervous, right now capturing the attention, of course, the spy balloon, the Chinese spy balloon, and now perhaps escalating tensions between the U.S. and China. We do have Lockheed Martin and Raytheon both down. This, of course, as China has issued fines and sanctions against these companies for trading with Taiwan. And Ford, well, it has flipped higher. Earlier, it had been down by 1.2%. This, Alex, of course, as China is saying that with their battery production plant, that they're going to take security measures to protect their intellectual property.
All right, Abby, thanks a lot. Really appreciate that. Some breaking news for you. Bank of America will be cutting jobs in their investment banking unit as Wall Street in general winds up retrenching. This goes beyond sort of a pause in hiring. This would now affect potentially about 200 bankers globally, and this is according to Bloomberg reporting. We will continue to update you on those headlines. Bank of America cutting jobs in its investment banking unit. All right, let's get to some other data we got today. You got those high mortgage rates continuing to weigh on new home sales and construction in the U.S. You got housing starts dropping for a fifth month in January. Here with us now is Mike McKee to break it all down. Hey, Mike.
One thing those Bank of America bankers could do is go into construction, because we need a lot more construction workers, even though housing starts declined this last month. It's kind of odd. You see the fact that we had the mortgage rates going much higher in recent months having an effect on housing starts. They were down 3.4% in December, down another 4.5% in January. How much of that is weather, though, and how much of it is mortgage rates? That's a hard question to answer at this point, because we've had bad weather in the east and in the west over the last 2 months. Now, building permits do show a little bit better trend. They're up by 0.1% during the month of January, as builders still have some confidence that they're going to be able to sell what they are putting in the ground. You can see the slight rise there, but after a couple of months of decline, 3-4 months of decline, you've got building permits rising again. And here's the trick to the whole thing. Why are home builder stocks going up? Because they're still building and selling homes. Here's the housing starts number, new home sales number rather, in white, and here is the housing under construction. You can see we're still building a lot of houses, even if new home sales have fallen off some. So construction remains strong. That keeps commodity prices for some construction materials up high, and it creates a need for construction workers. So if your bank is, if you can't be an investment banker, I'm sure you can find a place to swing a hammer.
Good segue, man. That's good.
That is brutal. I literally am just imagining people in suits and ties, Mike, like with a pickaxe or whatever you use to do construction.
They're making that up.
I don't know. Would it be? No, that's... Maybe, I don't know. Okay, I'm going to stop talking before I say something else dumb. Mike, thank you so much. Bloomberg's Mike McKee. A drill? I don't know. Anyway, joining us now is someone who knows a lot more about home building than I. It is Sheryl Palmer, CEO of Taylor Morrison, who recently had earnings. Sheryl, thanks so much for joining. Thank you for bringing your expertise, which I clearly lack, to the show this morning. Look, your numbers, really strong start to the year. It's clear that momentum is picking up with home shoppers, at least for the beginning of 2023. What was the strongest market for you?
Well, thank you. It's so good to see you and so good to be here this morning. You know, you're right. We did report our fourth quarter and full year 2022 yesterday and talked a lot about the momentum that we saw really begin in mid-January. We came off the fourth quarter that was pretty slow, and that's why I'm not really surprised on the starts number this morning, because certainly there's a lag effect. But when we got to kind of mid-January, we have seen the consumer back in the marketplace, I think, with a little bit more confidence than what we saw in the back half of last year. And honestly, we're seeing it across the country as well as across all consumer groups. The first-time buyer, a little bit more difficult as we still work through price, the combination of price and interest rates, but we're working with them and getting them, you know, to the finish line.
So to that point, Sheryl Hayes, Alex, it's really good to chat with you again.
Yeah,
it's been way too long. So to that point, do you have to offer more incentives? What do you have to do on your end to kind of close the deal? And then how does that feed through to your margins?
You know, Alex, yesterday we reported record margins for the company for the full year of 25.5% adjusted margins, up over 500 basis points year over year. But having said that, yes, in the back half of the year, we saw incentives move up, and it was really a combination of lot premiums, incentives, in some places base price adjustments. But really what we've done, Alex, is we have continued to use finance as a sales tool and make sure that we work with every consumer and understand their specific needs. Some of them need cash to get to the closing tables. Some of them we have 3-2-1 buy downs or 2-1 buy downs, or they just need a good 30-year fixed rate. And so it's really customizing the program for each individual and helping them get to the closing table. As we've moved into 2023, you know, we've seen rates pull back. So those incentives, you know, we are working to pull back the cost that we're having to provide the consumer.
How do you make the math work then and keep those really punchy margins then, Cheryl?
Well, you know, we have had the benefit of working off of good land that we've owned for years and years. Obviously, we have not seen the benefit of construction costs moving down. We are starting to see some tailwinds on the lumber side, but production is still got a ways to go, and the supply chain is still tight, as is the labor market. But right now, it's about continuing to get volume up and working with every consumer. And I'm more concerned about that and making sure that we have the product at the market to help each of our customers. You know, we have a good mix of inventory homes and to-be-builts, and with our consumer mix, when they get the opportunity to pick their lot, pick their house, you know, all their design features, that also goes a long way.
Yeah, and that just goes to show when you have sort of starts and sales have that wide gap, you expect sales to go up to meet it, as the chart that Mike was just talking about. What is the most resilient part, either geographically or demographically, that you've noticed, and where are any cracks?
I would tell you, as I look at the end of the year, our second move-up buyer was our strongest pace buyer. But having said that, we actually, as we've moved into the new year, we've seen the first-time buyer begin to return once again, with interest rates moving from where they were a few months ago to, you know, the mid-sevens to something that was in the high 5s or 6, that we really had the ability to then assist them move that to something in the high 4s. We've been offering 4 and 7/8 for a while now. So I would say the move-up buyer and the lifestyle, what we call our 55 plus, our resort lifestyle buyer, has been very resilient. And we're beginning to see that first-time buyer come back into the marketplace. Each geography has a slightly different mix, and I'm seeing a slightly different consumer with different strength. But if I look across the entire portfolio, truly we're seeing all the markets that were really stressed. I'll take Phoenix as an example, really come back and see sales momentum continue to rise.
Hey, Cheryl, just quickly here, because we're almost out of time. There are concerns certainly that the Fed is going to keep raising rates to deal with this hot data coming in. At what level do you start to worry about affordability of housing? At what level do you say, okay, the market pulls back again?
You know, Alex, I think our buyers are generally in a good place. And, you know, we talked yesterday as well about our consumers, our conventional buyer consumers, still having about 400 basis points of room from what we're closing them at in interest rates. Our FHA a little tighter, probably closer to 200. But I think it's about consistency of the rates. If I go back to the fall, Alex, we were seeing 50 basis point rate movements almost on a daily basis. And how do you get any confidence if you're not sure if you should wait or you should lock? So I think if we're in this low to mid 6% range, we're in a good place, and I think the consumer can adjust to that 6%. I think if we start moving back into the 7s, they're gonna think a little bit more about that.
Yeah, no, that makes total sense. Cheryl, really good to catch up with you. Thanks a lot. It's been too long. Come back soon. Cheryl Palmer at Taylor Morrison, CEO. Thank you very much. All right, coming up, we're going to stay with the company theme here. Hyatt posting very strong profits in the fourth quarter. We're going to take a look at whether it's anticipating any slowdown in bookings due to a possible recession later in the year. We're going to speak to the CEO next. This is Bloomberg.
Shares of Hyatt reach an all-time high. They released results this morning, posting strong fourth quarter profits. Joining us now is Mark Hoplamazian, President and CEO of Hyatt Hotels. Mark, it seems like everybody is out, they're traveling, the consumer is doing strong. The question is, do you think it can continue? Can that growth sustain itself through the entirety of 2023? Good morning, Mark.
Good morning. Thanks for having me. Well, look, we finished a transformative year last year with another record quarter, but even more encouraging and responsive to your question, January has started off very strong. So we're seeing great demand across leisure, which shows no signs of weakness, and that's globally, including China, which had a record Lunar New Year travel volume. And then group business among corporations and associations is looking very, very strong. We're tracking 20% ahead of next year in bookings, 20% ahead of last year, rather, in bookings. And so we feel really strongly that's going to be persistent. And mostly it's customer-facing events that corporations are absolutely holding on to. And the pickup rate, that is the attendees versus the actual number of rooms booked initially, have been higher. So we're seeing more people show up at these events than less. And then finally, business transient travel is coming back. We finished the fourth quarter of last year down 18% to pre-pandemic levels. We ended January down 17%, but the first 2 weeks of February are down only 12%. So there's a steady improvement in the volume of business transient travel as well.
Hey,
so across
Mark,
all those segments, we're seeing positive progression.
Mark, what's your pricing ability on that? If the demand's going to hold up, can you raise your prices? And I asked that because Danny and I spoke with Marriott yesterday, and they're increasing their business rates, and they seem to be somewhat sticky. Can you give us some insight?
Sure. We have what we refer to as sort of key corporate accounts or volume accounts. And for those major corporations that represent our top 20 customers, we have negotiated rates for those travel programs. And we expect that the increase year over year in the rates applicable to those top customers will be in the high single digits. So that's a pretty significant demonstration of the level of demand and also the relative pricing power that we're carrying over from last year.
Can I just put this all into wider context then, Mark? Do you think there will be a recession given what you're seeing just on travel demand alone?
I think there might be a slowdown, economic slowdown, relatively speaking, in the second half. We don't see any signs of a first half issue at all in any of our data, even though our booking curves don't extend all the way through the year except for group business. And we accept the fact that there could be a relative economic slowdown in the second half. We don't think it's going to be acute for our customer base. We are focused on the high-end traveler. And so we don't believe that it's going to have a pronounced effect on our core customer base, but could have an effect more broadly on the economy. But at this point, we're not building in a significant and severe recession.
You mentioned China and sort of the reopening part. Let's talk about the conflict part. You see China sanctioning Lockheed and Raytheon over Taiwan arms sales. And I'm just wondering, as more headlines come out, do you feel confident building out your business in China? What's your pipeline? How do you think about that as a CEO?
Excuse me. We do have a significant pipeline in China, and the secular growth that we see looking forward is significant. Excuse me. And what I would say, first of all, is lodging is not a particularly focused on industry from a sensitivity perspective as far as the government's concerned. Secondly, we are a huge employer in China and growing significantly. We have 120 hotels open with a similar number in the pipeline. So we are increasing our employment base, which is nothing but good for the local Chinese economy and for the citizens of China. And we're also supporting local purveyors and really a part of the local economy in all the regions in which we operate. So I think we, in many ways, we're a part of what China is looking for, which is job growth and supportive of small and local businesses. So I think I'm not concerned that we're going to be targeted as an industry. I think the key issue is when will travel in and out of China start to open up? We don't think that that's going to happen until very late this year. There are many structural things. Passports need to get renewed. Visas need to get reissued. Airlift needs to be restored. So
certainly a lot of factors going into that, Mark. I do wonder. You've made quite a few acquisitions in the U.S. Dream Hotel Group. Before that, it was Apple Leisure, Two Roads Hospitality. What are you buying next, Mark?
Stay tuned. Every one of those has proven to be a great growth platform for us. We've got our 6th consecutive year of industry-leading growth behind us, and every one of those platforms has brought with it growth into the future, but also something unique to offer our loyalty members and our guests.
Okay, Mark, thanks so much for joining us this morning. Mark Hoplamazian, President and CEO at Hyatt Hotels. This is Bloomberg. All right, Bank of America looking to cut some jobs in its investment banking business. The number of reductions, though, still being discussed, but it could affect more than 200 bankers globally. Joining us now is one of the reporters who broke the story. Catherine Doherty joins us. All right, Catherine, put the 200 into perspective versus other banks, but then what it means for Bank of America.
Right. So at other banks, we're seeing thousands. This is nowhere near that. This is likely to be under 200. And so it might not seem extreme, especially when you're looking across the street at peers, but for Bank of America, it is a step further. They put a pause on hiring, bringing new people in. That was to account for less people leaving. So there was just a natural attrition issue that they were dealing with. And now it's really a return to business as usual, pre-pandemic cuts that happen normally after bonus season this time of year. It's pretty typical, and it is not the extreme culls that we've seen at Goldman Sachs, which was actually some of the biggest cuts that we've seen at their business. And it would be more similar to Citigroup, which was a few dozen in their investment banking unit.
Does that then say something about their performance, Catherine, or how do we account for the discrepancy between these banks and the numbers they're putting out?
So the performance would be across Wall Street. We've seen deals dried up last year. There's less fees coming in the door. So that means that they have to really think about expense management. If you have less money, you're going to be able to get through for a number of months or quarters, but at a point you have to start making decisions, and you have to maybe think about how to keep your expenses in check, and really we're waiting for a meaningful rebound in deals. The start of January and really this month in February, we've seen more activity, so we could eventually see less of a pullback and less of a correction in terms of management and headcount numbers. But the big picture here is that across Wall Street, as less money is coming in, at least in investment banking, they're having to really think about their headcount and how many people are actually going to need to stay for the types of deals that they're doing.
So on the flip side, though, I feel like wasn't Brian Moynihan out already being like, we're not going to be laying off people, we're okay? So this in Bank of America, though, is a bit of a reversal of that.
So they have always touted that they are different than other banks, that they're saying we're not doing massive layoffs. And that's what you've seen in the thousands at other peers. They are not going that far. This is more business as usual. So when there was a pause during the pandemic and really the job cuts were not happening at Bank of America, they've started to resume. Now, it's not these massive layoffs, it's not a cull, and that's what you've continued to hear from executives. But it is a step further than just a hiring freeze or no cuts at all.
Yeah, Bank of America stock pretty much flat on that. Catherine Doherty, thank you very much joining us from Bloomberg. Danny, we're off the lows here in the U.S. I got to say, S&P just down 0.6%.
Yeah, well, in Europe, we are firmly up. The Europe and U.S. trade differing. It really all comes down to earnings. We're looking at the stock 600. It was lower, I should say, when stocks sold off. So, yes, of course, there's a relationship between them. But when you look at, for example, the CAC 40 hitting a new record, at least if it holds at this level over the next 34 minutes or so, it will end at a new high. It is all about earnings. We had Orange, we had Pernod Ricard, we had Kering yesterday, we had Airbus. It is all these earnings that are very strong, and that's propelling us to new levels. It also follows the FTSE 100 reaching a new high yesterday as well. But one thing that is trading like the U.S., it's the bond market. German 10-year yields almost at 2.5%. Falling, rising in sympathy, those yields with the U.S. story. And we also had Philip Lane talking, saying that much of the tightening, it is still in the pipeline. Well, coming up on the European close, we're going to continue to talk about these markets with Kiran Ganesh from UBS. This is Bloomberg. It's Thursday, the 16th of February. Earnings propelling European stocks higher. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Just about 30 minutes ago until European markets closed. Not a great day for bonds. They are getting hit twofold. One from the story in the U.S. from another piece of data coming in hotter than expected. This time it was PPI and Loretta Mester talking about her last preference for 50 basis points at the last meeting. That means U.S. yields going higher. That means German yields moving higher. But we also heard from Philip Lane saying that there is more tightening in the pipeline to be felt. So maybe you could interpret that as dovish, that, you need to see what the effects of the ECB's tightening are. But of course, he still wants to go at it harder. Now, European stocks, those have been resilient today. They were down earlier, but ending the day higher, up by 0.1%. But Alex, the real outperformer has been the CAC 40. I'll get more into this in a little bit, but that's up about 0.8% so far.
Yeah, that action really over in Europe, pretty impressive as well. All right, here in the U.S., tell me if you've heard this one before. So you get Mester talking about 50 basis points, a hotter PPI, S&P was down a full 1 percentage point, and now we're just down 0.6%. Utilities the hardest hit, though, within that as yields climb. Yes, the 30-year was the biggest mover, the back end underperforming, but we're only up 3 basis points. We were up 8 or 9 basis points. I say that because, yes, we're at the highest yields that we've seen so far this year, but this reversal is still surprising. This feels a lot like what we got on retail sales day and on CPI day. It sort of makes sense for a second, and then all of a sudden, positioning and options really take over. One area that has a cleaner read-ish is a Bloomberg Dollar Index up 0.1%, and specifically with euro dollar getting hit now down 106. There could be some more potential for a shakeout there. That's what a lot of street strategists are saying. So just watch for potential dollar strength in the meantime, Danny.
Yeah, I got to say, I wonder if that duration story is really just about how juicy yields are right now. We saw yesterday the 20-year auction record overseas demand. So maybe every time yields come up, someone wants to buy. I did mention the CAC 40 that I would get into it, and I'm a woman of my word. So it's trading right now at a record level. We're almost at the close, and it is very likely going to end there. Now, the interesting thing about this is the first burst of gains we had on the CAC 40 was like the entirety of the market. It was that pandemic resurgence, that revenge spending. Remember, French equities have a lot of luxury goods, a lot of consumer-facing stocks. This pop-up here we've had is a lot to do with China. It's a lot of the luxury companies. It's Pernod Ricard, it's Kering, all of those sorts of names that have thrust us higher. And also contributing to that, Alex, is Airbus. They also had earnings. Demand is strong. Yeah, maybe some supply chain weakness, but it is clear that there is still strength in this European economy.
Yep, which leads us to Airbus, for example. So Airbus is making up about 13 points, 14 points of the rally that we're seeing in the CAC 40 today, which is about 68 points. So Airbus having a big impact. Now, they had earnings earlier today, the stock near a 3-year high. Well, we heard from the Airbus CEO earlier today after those earnings came out.
We see a very strong demand for traffic of passengers around the world. There was a very strong demand for cargo during COVID. So the return to good times is indeed accelerating. We see now the opening of China contributing to the global recovery of the sector. And it's now a market where demand is actually stronger than supply.
France at an all-time high while U.S. stocks slump. It gets us to our question of the day. Europe versus the U.S. Which one you picking? Joining us now is Bloomberg's Jan Patrick Barnett, and Christine Aquino. Christine, let me start with you. Which has more room to run here? Is it Europe or is it U.S. equities?
Well, Dana, it really does feel like Europe is about to have its moment here, right? I mean, it is well positioned for any investors who kind of got burned by those high-priced tech stocks in the U.S. that really got battered in 2022, and now that cash is looking for a home. And, you can find that very much in the value central that is Europe. And then, as you mentioned as well, that China recovery story, very much a positive for Europe. That really is only just beginning, right? We're only still in the early stages of China emerging from that COVID zero era. And now we're just kind of starting to see the economy returning to normal. I don't think that story's done. I think that story's just beginning, and we're really probably not going to see the full effect of that until later in the second half of this year. And so that's going to be something that would give Europe another burst of momentum, even if, for instance, some of this optimism that we're seeing in the first half falters.
Hey, JP, I find it really interesting, though, that today, when the CAC 40 hits a record high, we have strikes. Strikes again. They're like crippling the economy. It's like somehow these two things don't make sense.
Yeah, that's absolutely true. But is there a day in France where there isn't a strike? So
Also
I would say
fair.
that's a common theme that's always appearing here in Europe, that we have our strikes from time to time. But I have to agree fully. Like I'm in Team Europe here as well. Europe has a lot of appeal right now. And if you look at valuations, for example, every single sector in Europe has a discount to the US. So that's very attractive for investors. The negativity that was priced in last year for Europe going into a recession, and with all the trouble from the energy sector, is being priced out now really hard, and investors looking at through those upcoming more tightening from the European Central Bank. And then you have the link to China on top of that. So Europe is looking really strong here at the moment, I would say.
I worry that we're all a little bit biased, Alex. Everyone we got here, including myself, is in Europe, so I don't know.
I'll
Something
do
to
Team
keep in
US,
mind.
but I'll just fight it.
There you
in
go.
a second. I'll think
someone
about
needs, Someone needs to hold down the fort. JP, can I go on that China story, dig into that a little bit further? Break just down why Europe is a bigger beneficiary of China reopening than the U.S.
Well, I think like the connection from Europe to China has been stronger in the past, and it's probably going to be stronger going forward. You have both. You have exports and imports linked to the country. You have, as you mentioned already, like the strong luxury and consumer link that is going into the China, as well as domestic consumption, that people are in China consuming European products, but as well as that Chinese people are coming to travel the old continent and spending a lot of money here now that the borders are open again. So that is definitely helping them. I would also say like that the geopolitical tensions between Europe and China are less pronounced than between the US and China. So that's also helping a little bit here. Despite all the fragmentation we have in Europe, I feel like the relationship is pretty good. So that's putting Europe ahead of the US here in terms of the China relationships, I would say.
Hey, Christine, I mean, it's obviously hard to argue with these points. However, I wonder how we separate them. Like, are there certain areas of Europe that can truly outperform the U.S., or are we just also like baked in at some point? I mean, I understand the China story. I get the luxury story. But at some point, after you hit 52-week highs, it's got to take a break.
Yeah, Alex, I mean, none of these moves really happen in a straight line, right? And so I'm mindful of Danny saying that we all have the home bias here. So let me play devil's advocate. I mean, it's really not plain sailing for Europe just yet. We're really not out of the woods just yet. What we are seeing at the moment is some signs of green shoots, optimism, right? A slightly milder winter helping some of the sentiment here. And then, as JP mentioned as well, that China story, very much a tailwind for European markets, but we have a lot of issues still. I think, we hit it, the nail on the head mentioning the ECB, because I think that could be potentially the wild card, right? What the ECB does with respect to the Fed. We've heard some very hawkish messages from Christine Lagarde last week, but already we're seeing a little bit of that message getting tempered by some of her colleagues in the governing council. There's definitely a bit of a debate brewing there over how much they can do, and also how much they can do that the Fed can't match. And so that will have a lot of implications, of course, for instance, the euro-dollar cross, which we see is under pressure today because, again, we've heard from Fed hawks. It's really hard to out-hawk the Fed hawks at this point in time.
I think you read my mind. That's exactly where I wanted to go. We need to keep in mind that S&P is priced in dollars. A weaker dollar was something that was helping it rally to start the year. How much does a hawkish Fed, or at least renewed data that suggests they need to go further, change the relationship or change our expectations for euro versus dollar this year?
Yeah, it's going to be very interesting, Danny. And again, it is a matter of, it's a battle of the hawks, right? And because the Fed has had the advantage for so long, being the first one out of the gate with rate hikes, they've also done the most in terms of nominal tightening. The ECB really is just getting started in a lot of ways. It's still quite behind the Fed. And so if we get into a situation where, for instance, the Fed at some point decides, all right, it's time for us to pause, it's going to be difficult for the ECB to convince investors, no, we're going to keep going when the Fed is already at a pause. I think that's part of the communication problem that Lagarde faces, is that as hawkish as she might want to sound, investors find it hard to believe that the ECB will go it alone when we have the Fed pausing. The Bank of England, for instance, very clearly actually signaling that they're near the end of their rate hiking cycle. It's difficult to imagine a situation where the ECB is going it alone and everyone else is a little bit more subdued on rates.
Yeah, I feel like we've just scratched the surface of this convo, guys. Team Europe wins, though. Christine, JP, thanks so much. Really appreciate your time today. So coming up, we're going to continue the debate, the U.S., UK, and Europe, with Kiran Ganesh, a multi-asset strategist at UBS. He joins us next. This is Bloomberg.
Earnings season continues.
The chips are down.
Earnings coming in fast and thick.
A slew of bank earnings this morning.
Bloomberg breaks the numbers first.
Numbers coming through from Shell.
LVMH numbers are hitting the tape right now.
We had a very good set of numbers in the fourth quarter.
Feel confident with the guidance we've given.
The situation has changed completely.
With exclusive expert analysis.
Europe's the most valuable company.
Trending towards the higher end of its historical range.
You think that can continue? How do I play this?